everyone, and welcome to IndiNations, 7 Generations Investing. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to have a continuation of our prior 2 episodes where we talked about starting the tribal treasury model and that time horizon-based investing that we think is so important here at IndiWealth. Today's topic is on intermediate tribal needs or investing for intermediate tribal needs. It's a continuation of the short term that we did last week, but today is much more about a balanced approach for reserve funds and for capital projects. So it kind of sits in the middle, and you'll see that here going forward. But without further ado, let's get started. So what is the purpose of intermediate term capital? And it really, so if you look at our treasury model, we have kind of 3 delineations: is the operating cash and rainy day, which we talked about last week. And then the long-term assets, which we'll talk about next week, is kind of your very long-term focused, I call it 7 years plus, or your perpetual funds, right? Well, this sits in the middle of that. This is kind of for reserve funds, contingency type of things, and then also for known capital projects. A lot of times, and especially in tribal governments, there's things you want to build in the next 3, 5, 7 years that you need financing for some of it, but you also need to use internal investments for a portion of it. And you need to have that on an incremental basis. Sometimes it's known, sometimes it's not perfectly known. But these are the kinds of things that you'll want to do in an intermediate basis. It's not perpetual in nature, and it's not day-to-day operational cash. So some of the common uses, again, projects with known timelines. If you have something in the next 3 to 5 years, you need finance, or you need assets to be delivered in, let's say, 6 months, then another one in 18 months, then another one at 3 years at the end. You can delineate for that, and you can set up a plan and a structure that allows you to invest for those different time horizons. Replenishing operating funds. Again, this is contingency and reserve areas here. Whereas if you start to see a little bit of a bleed down in your operating funds and you need to replenish that over an extended period of time, or even temporarily, or even just planning for that, in your reserves, you have 1 to 2 years and you say, well, I want to have another 2 years of contingency reserves set up. That's where this can sit. So as that gets bled down, you're going to be using that, and then you're replenishing over an extended period of time, and that cycle kind of continues. Funding delays, economic downturns, temporary hardship support. These are what I would call contingency planning. This is saying, hey, we know things are going to not run perfectly at all times, and so we need to plan for that. And so funding delays, a lot, with regard to government contracting, with regard to, anything that comes out that has a funding mechanism that could potentially get delayed. You don't want to delay your projects as a result of that. So you want to be able to, if you can, put a buffer in those for those potential delays that eventually get recouped by that funding source. And then in economic downturns, frankly, the statistics in Indian country, they feel economic downturns a little bit more aggressively than the overall average economy in the United States. It's unfortunate, but it is what it is. And you have to understand that sometimes there's going to be some more support that is needed as a result of that. And so when you're feeling the economic pain of that, you want to have a contingency or reserve plan where you can step in as needed to fulfill what may be just in a cyclical downturn, or something happens. Everybody probably listening to this probably felt through COVID some of this stuff, whether that was economic downturn where we told everybody to go home and stop doing things, or just from the hardship perspective and the effect of, hey, they told me to go home. I'm not working. There's nobody coming into my store. There's nobody coming into my business. Is there anything you all can offer me as a tribal government to help support your citizens? This is where that sits, is that you do not want to take the full risk of the market in these contingency plannings, but you also don't need them all in cash. And that's your only emergency reserves, because as we talked about last week, those short-term reserves are covered via very safe investments in our short-term capital bucket. So let's talk about the key principles here. Asset liability matching. This is where I think this comes in very well. Longer term planning, 7, 10, 15, 20, 30 years, There is some asset liability matching you can do there, but I really think it shines in the next 3 to 5 years because you say, hey, I'm going to build a health facility and here's the financing I need and here's the investments that we need to come out of pocket with. How are we going to source that in what time frames? You're building that in. You can build the investments to fit that timeline. And so I think this really works well here. And you can generate a pretty decent level of return by matching those assets to the proper time frame. And also, those assets are going to be there when you need them at that time frame. Understand your liquidity here. Where I said in the short-term reserves last week, I said basically you should have highly liquid, right? Is that there should not be anything really illiquid in your short-term reserves. In your intermediate term reserves, you can allow for some illiquidity, but beware of the lockup provisions of anything you do that has illiquidity on it. So understand how, hey, let's say I need this for contingency planning, or let's say the funding actually gets accelerated and I need to do this because I want to take advantage of something else, or, building costs are cheaper and these kinds of things now. You don't want to lock yourself up in such illiquid investments that you can't access them when you need them. So just understand your liquidity here. Again, some illiquidity is okay here. I would caution against too much, and just understand that, hey, if I need this capital, how do I access it? How much am I willing to say, no, I know I'm not going to need this for a few years or even 4 or 5 years out. So I'm okay with some illiquidity there, but I have enough contingency planning that's in readily accessible investments that I can sell and utilize right away. I think this requires a balanced risk approach. I don't think it's too aggressive. Again, that's your long-term funds where you are going to be okay with having the ebbs and flows of the market, because over a longer period of time, you'll be able to take advantage of those kinds of things to enhance your long-term return, because the money's not due in the next couple of years, right? You've already got that taken care of. Here's where that sits as a hybrid, is that you don't want to be too aggressive. You want to protect yourself from some of the downside risk that the markets can intertwine. If I think about 2001 to 2003, during that period of time, it was a pretty substantial decline downward. And if you were sitting there with illiquid investments over a longer period of time, you're just continually bleeding down. And now you're 2 years away. If you were 2 years away, now you have 3 months left of that money and it's 40% lower. That's where you have to be careful. You have to incorporate some level of protection from downsides of the markets, but you also don't have to be purely in cash or in highly liquid, low maturity investments like I recommended for the short-term reserves. Again, a balanced approach here is probably the best approach. The hybrid component: capital appreciation and income. Again, you can see I'm not focusing on just pure capital preservation like we talked about last week for the short-term reserves. Here we can grow a little bit. We are okay with taking some risks to try to grow these assets in this pool over a longer period of time, but we want to be sure that we're delineating. So the stuff we're getting closer and closer to in actually needing, we want to start being more and more conservative on those. If we're in contingency planning and we've built up our contingency assets and those have grown and grown and grown and we haven't utilized them, well, we can potentially use that for some growth while still holding enough in reserves that allow us to, if the trend's the other way, that you can utilize those assets. So I think a real hybrid approach of some growth and some income is probably the best approach here. So what does this look like when we talk about a balanced approach? What does that mean? Well, I'm not going to talk about assets just yet because I want to talk about structure a little bit more first. So let's start here. It was enough liquidity for your timeline, for the tribal timelines and the contingency planning that you've done. So you've delineated what you've needed from short term, your next 1 to 2 years, you've already delineated that. How much do we want to have in contingency planning in case our forecasts were wrong, or in case the economy really tanks and goes the other way, or in case we have a temporary hardship that we want to support? How much in contingency planning do we want to have for that? And then what are our capital project needs for the next 3 to 5 to 7 years that we can plan for as well? So you want to have enough liquidity that you can source when you need it. So that's where you want to start, is like, how much liquidity am I okay with? How much illiquidity am I okay with? Because I know that unless really things go poorly, I'm not going to need this money for 3 to 5 years. and what are my outs if I did something illiquid to try to earn a little bit more return. Just knowing that and understanding it and having that contingency planning, I think, is well worth it, and what a balanced approach would start with. Again, compared to your cash reserves, what we talked about last week, you should have a higher return potential here. You should be willing to take a little bit more risk here. But again, not as much risk as you'd take for your perpetual funds and things you're not going to need for 10 plus years down the road. You should be comfortable with a higher degree of risk there than you are here. But here, you should be comfortable with a higher degree of risk than you are with your short-term reserves. Again, sitting in the middle. Less volatility and more protection than long-term assets. That's what we just talked about. Here, you don't want to bounce up and down quite as much. You want to have some of that downside protection to absorb it, because you are going to be using this money. Again, if you have a protracted decline in the markets, you don't want to absorb the full extent of that and then have to sell when things are massively down. So you want to incorporate some level of reduction of volatility and also just greater protection, especially on the downside. Even if that comes at the expense of not generating the full upside of return. Right? We have to be okay with that the cost of protection sometimes is that you give up some of that upside. You have to be okay with that here, but you certainly don't want to be so much in cash on this side in the intermediate term that it reduces your ability to grow over an extended period. Structure your investments to align with your capital needs. Really that just means setting up. Again, asset liability matching is pretty good in this area. I do actually like that, or at least planning around that. Setting up contingencies and then setting up liability matching for the known elements that you're going to need going forward, I think is a great way to kind of think about a hybrid approach. And again, your risks are matched to purpose. As you get closer, let's say you had a project that's 7 years out, well, you could probably take more risk there at the outset, right? You have a longer period of time. As you get closer to 3, 2, and 1 years, those assets that you've earmarked for that now have a much shorter term. And so your risks should be adjusting more and more conservatively for that pool of assets. So as you get closer to utilizing those assets, you want to have a greater certainty that those assets are going to be there to use. And so you can't just say, well, I have a 7-year plan. I'm going to do a 7-year investment. That's, stocks 70, 30%, call it a day. You have to incrementally dial that back as that investment gets closer to fruition. So what do we do from a common investment strategies? How do we kind of set this up? How do we set up a balanced approach? I start with here in that bond and laddered fixed income works pretty well here. And if you remember from the short-term reserve side, I talked about bond structures. You probably don't want to take a lot of maturity risk. You probably don't want to take a lot of credit risk when you're talking about short-term reserves, because you need that money in the next 0 to 24 months. Here, you can take a little bit more diversified bond exposure. You can even take a little bit more risk here to generate a little bit more income and those kinds of things. And again, under that asset liability matching, a lot of times what works is a laddered strategy in that, hey, I've got 7 years. I'll do 1, 2, 3, 4, 5, 6, 7-year ladder where it sets up so that if I need a portion of those assets every year, well, 1/7 of that matures every year, and I can take those assets and use them as needed. So a laddered structure works pretty well here, but also just a general diversified bond structure where you can take advantage of if the markets are opportunistic for taking credit risk. Let's say we've had a real economic downturn where, the premium you're getting paid to take on the risk is really aggressive and really opportunistic. Well, you can take advantage of that here and still be okay. You don't want to go crazy, but you can do that here. Whereas in short-term reserves, I would have said that's probably not worth it. Blended equity and bond, that's your common stock and bond allocation. How much do we have in stocks? How much do we have in bonds? Well, a lot of that percentage will be based upon your time frame. And if you have 7 years, you can probably take a little bit more equity risk during those periods of time. And then as it becomes closer and closer to fruition for what you need, you should probably be tilting more towards the bond-based approach. So you can do both growth and income in a intermediate term capital investment type of strategy. But the bonds are primarily used for downside protection here. Some income, but also for downside protection. Now, what happened was, if you think about 2022, 2022 was one of the most difficult years from an equity and bond allocation perspective, because a lot of people invested in bonds, and they were investing because rates were relatively low at the time. They were investing in long maturity bonds, a little bit more credit risk. They were trying to get incremental income because there wasn't a lot of income to be had at that point. Well, what happened in 2022 is we had the high level of inflation and interest rates rose very, very fast. And when interest rates rise really fast, bond prices fall really fast. And the more maturity risk and the more credit risk you're taking when you're doing it, the worse that is. So 2022 is a real evidence for people in saying, man, my stock to bond allocation, when I tried to protect using bonds did not provide a lot of protection during that period of time. So it was a little bit of an awakening to saying, how else can I do this? And how can I diversify assets to make more sense for me long term? And I'll get to that in a second. Defensive equity is absolutely considered one of these hybrid type of strategies, whether it's dividend yield stocks, whether it is more defensive sectors like your consumer staples, your Procter and Gamble's of the world and these kinds of things, your Coca-Colas, your utility stocks. Those tend to be considered pretty defensive. Sometimes healthcare, sometimes not. But those sectors and those segments, high dividend yield, value stocks, these kinds of things, anything that has a history that is repeated, it doesn't work every time, but if it has a history of repeating itself, of holding up better in downturns, you can use a portion of that. It's not a perfect element by any stretch. There are times, even in negative environments, where growth stocks do better than value stocks. And so that's not perfect. And dividend yield stocks can have difficulties too. So while defensive equity can absolutely be used, I wouldn't use it as the only component of protection, because sometimes that protection isn't necessarily as good as you think it is. Which leads me to the last one, and I'm not going to spend a ton of time here, but option overlays and structured notes really kind of took hold in 2022 as viable options for, whether it's an institutional or a retail investor, as real elements of trying to protect downside in a different way than bonds, because 2022 bonds did not protect you. Right? If you had, 20-year treasuries and the number went, and the interest rates went way up, those 20-year treasuries got tanked. And so people were saying, well, if I can't use that, what can I use? Well, there are option overlay strategies where they use options as part of your equity strategy. There's also structured notes where you can build a lot of different customizations to provide you some downside protection. But really what you need to understand here is that you can build these structures to do a lot of different things, but you need to understand what you're trying to do before you invest in these structures. Because if you don't understand what you're investing in, you could take risk that is unforeseen and really not what you're trying to do with these things. So these have a layer of complexity and customization that really, in my opinion, requires some professional oversight and really a clear explanation about what we're trying to do when we incorporate those things. But I do think all of these strategies can be utilized as part of the whole solution, right? So if we think about intermediate term needs, we could use some laddered fixed income. We can use some diversified bond. We can use some defensive equity. We can use some option overlays and structured notes. We can even use, a blended stock bond allocation kind of thing. You can use all of this in the proper components of a holistic intermediate term strategy. So all of these things, they don't have to live in a bubble independently. They can all be used, just have to use them in the right fashion and understand where the weak spots are as well. So mistakes to avoid here, I think in intermediate, I think the first one, I talked about this in short-term reserves a little bit, but treating all reserves like emergency cash isn't probably the proper fashion. Now, again, it's going to have a relative component of safety, but inflation is probably going to eat into those returns and it's really going to limit your long-term growth. You want your money to work for you. You really do. And in this instance, treating all your reserves like emergency cash is probably going to lead you to have a much higher cash allocation than you actually need. So being able to delineate what goes where really will set those investments so that you can earn some return even while still having that contingency planning that you want. Compromising liquidity when you need it most. I talked about temporary hardships, economic downturns. Those contingency plans that you've put in place for those probably should be pretty liquid because you don't know when you're going to need them. That's why they're there. It's a contingency offering. Now, should it be in cash? Absolutely not. It does not need to be. You've already got your 0 to 24 months figured out in your short-term reserves. So this is contingency planning for if the short-term isn't enough, how do we access what we need? It should be in different investments, but it should probably be in areas where it has some downside protection, but also a high level of liquidity so that if you need to access the contingency, you can. Failing to adjust as timeline changes, I talked about that before, where you set an allocation for 7 years out. Your 7 years out should be your very different allocation from your 1 year out. So understand that and understand that you have to adjust as you get closer to using those money. I would say you have to get more conservative as you get closer to using that money. Using longer term assets to plug shorter term gaps, that's always a challenge because, again, the investment profile of something long term is probably going to be the one to take the worst damage during an economic downturn or those kinds of things. And so if you're plugging that, you're probably selling in a very inopportune time. You probably want to be using, your contingency offerings, which that's what they're there for, and hopefully have protected you a little bit to maybe even take advantage. It's like, okay, well, we've used a contingency, we'll replenish that. We also should maybe fill that long-term gap because now things are on sale and we can maybe take advantage of that over a longer period of time. So you want to be able to take advantage rather than doing crisis-led decision-making, which usually sells at inopportune times. So as I said before, I always try to end with why do we want to learn this and what are the benefits of getting it right? Well, the goal here is tribal financial sovereignty, right? That's the goal when we set these things up, whether it's social elements, whatever sovereignty means to you all. That's what you want to establish your investments to help you do here. And I think the process of doing it, again, I think time horizon is the best solution in doing that because it provides you with your short-term assets being protected. Your intermediate term assets are what I call bridging the gaps. Again, it's that hybrid approach. And your long-term assets are allowing you to grow and extend what you want to do as a tribal leader, as a tribal CFO. It's allowing you the opportunity to really extend what you believe is your best avenue to tribal financial sovereignty. Then your decision, by knowing these things and delineating, your decisions are clear and not crisis-led, which usually leads to bad decision-making. Transparent progress reporting. I love that from just, hey, how are we measuring this? Because if we're just measuring it against the stock market, well, it's kind of irrelevant to a lot of the assets we're trying to do. But are we achieving what we're trying to achieve? And are we set up in the proper fashion so that if we need to access contingencies, we're there? We have our short-term needs taken care of. Do we have that financial, plan for the next 5 years for that health center that we're putting together? Do we have the assets in place for that and delineated under the proper timeframes? By having that progress reporting being transparent and clear, you can relay that to your citizenship and saying, hey, here's the plan that we said we were going to set forth. Here's the assets that we're going to do. Here's how we're going to get there. And here's the progress we're measuring. And we'll see you next quarter when we do it again. Because I do believe the plan should be reviewed consistently because you need to know, did circumstances change? If circumstances change, that usually leads to investment change. I always say the market is usually secondary for asset allocation changes. Sometimes the market drives that, but it's honestly quite rare. What more often drives asset allocation changes or just shifts in investments is usually a change in what you want to use the money for. And that's absolutely fine. But the only way you're going to know that is reviewing it consistently and allowing yourself the flexibility to change as you need down the road. Because you as a tribal official, the one thing you know is that things are going to change down the road. You want to be flexible. The IPS is never set in stone from your investment policy statement. It should always be flexible to adjust as your needs adjust in the future. So again, this sits in the middle of our time horizon based model, which is a big part of our Treasury playbook for tribal nations. I will incorporate a copy of the Tribal Treasury Playbook in the description below. So feel free to access that on your time and see if there's information that's helpful to you. But I hope this was helpful to you. I hope it kind of gave a little bit more clarity about that intermediate term needs. Tune in next week where we'll talk about the long-term needs as we kind of put a button on the time horizon-based model. And then we'll incorporate that after that down the road into a little bit more broader approach and kind of how we do it on a cohesive basis. But until next week, thank you very much for joining us and take care of yourselves.